Hey everyone, I'm making a little bit of a different video today. I know I haven't made daily reviews the past couple of days, and I've just been working a lot on where my signal fails. And so, one of the things that I came up with a little while ago in order to avoid the larger losses was to stop trading against higher time frame breakouts. What I mean by that, I picked the 15-minute chart whenever I get a 3-bar micro channel or a 4-bar micro channel on the 15-minute chart. I just wouldn't trade against that signal. So if this is a 3-bar micro channel on the 15-minute chart, I could not take the sell signal because the higher time frame breakout. For example, this is a 3-bar micro channel on the 15-minute chart. And so I'm not really willing to buy the close of 63 because I know that when I get that higher time frame breakout against me, there's a 60% chance of a deep pullback. And it's still a 60% chance of the trade winning. But the way I defined a deep pullback was pulling back within a couple ticks of the low of the signal. So if you have a 60% chance of a deep pullback, it's really not great to be buying this close. And you can just see if you test against channels like this. The problem I ran into, really the only issue with that is that not all the time this actually was not a 3 or 4-bar micro channel on the 15-minute chart. It was a 4-bar micro channel on the 30-minute chart, but I needed to come up with a better way to sit out of these types of trades, other than just saying, yeah, it's a decent move against me, I got to stay out. So I decided to basically make I have a bunch of slides on it that I'm going to be showing, and just kind of talking through sitting out of these trades. And so basically the definition I'm trying to work with, I'm still workshopping a lot of this. So it's not going to be the most clear, but basically I came up with selling on bull channel lines when, we have a spike. So bars 1 and 2 were bar 1 was a bull bar. So we have a spike here, a pullback, and then a channel. And when you're selling against a bull spike and channel, there oftentimes are a lot of deep pullbacks and losing trades. So basically, learning to sit out against tight channels is going to be important. And you can see just on this one, this is what I would be selling against. So this is a 30-minute chart, right? On the 15-minute chart, it looks different, but it doesn't really matter it's still, you're still trading against a higher time frame breakout. And so trying to just be a little bit more loose with that definition rather than saying, oh, if it's a breakout on the 15-minute chart, I'm sitting out. But just, keeping in mind what the 30-minute chart looks like. And basically the whole point of this video, the whole moral of the story here that, you're going to get to, or I'm going to explain throughout the course of it, is I'm trying to avoid selling on channel lines. So I'm trying to avoid selling the bottom of a bull channel. If you're buying the top of a bull channel, you expect a deep pullback. My average pullback is 0.75 R when I'm buying the top of the channel. So you average essentially a 75% pullback for my signal when I'm buying the top of a channel. So you're going to get a deep pullback if you're buying the top of the channel, but that's not necessarily the worst thing in the world so long as you're prepared for it. But when you're selling the bottom of a bull channel, you run into a lot more issues. And so we're going to start with this. Selling the bottom of a bull channel or buying the top of a bear channel, right? Here are two situations where this is a bear channel. You're buying the top of the bear channel line. We have another tight channel down. You're buying the top of the bear channel line. This is 7 consecutive bear bars. And while, once you get 6, 7 consecutive bars, odds favor a complex pullback. It doesn't really, just because odds favor complex pullback, I don't really want to be buying closes on that channel line. So basically, again, there's a lot of slides on this and some interesting stuff I found on breakout points that I will be going over. But they both occurred against 3 and 4. This was against a 3-bar micro channel on the 15-minute chart. So I'm going to pull that up in a second here. But again, the point is we're making lower highs and lower lows, and we have a consistent channel line. So you do not want to be buying any sort of breakout on a bear channel line. If you're going to buy, you want to buy low in the channel. And if you're going to sell, you want to sell high. You want to sell, what started this whole move, right? This bear bar started the whole move. Well, traders were more interested in selling around that low than they were in selling to close. So when you're in channels, you look to sell breakout points. Bulls got trapped below a bull bar here. So we test back to it, and then we get another leg down. Traders get trapped. If they're buying, willing to scale in, they might make money. But again, just look for the start where the move starts. I have some statistics on that I'm going to share in a few minutes here. So that first 4-bar that second micro channel, right? We had If you can scroll back the video a second, you'll see 2, 3 bull micro channels. And this is the second one on the 30-minute time frame. You're trading against a 4-bar micro channel down. Really, do you want to buy this close? No, that's more of a sell the close bar. So it's not really all that great to be buying here when you have a 4-bar micro channel down. And the other one is, this is the 15-minute chart. This is a bear 4-bar micro channel. Here was the first reversal. And even here, breakout, follow through. And then, yes, a bull bar, but it's 3-bar micro channel down still. And so again, there's probably sellers up here. So you have to be really careful trading against higher time frame breakouts if you're trading breakouts in general, because those higher time frames are going to get small second legs, but those small second legs will stop you out on the lower time frame. So again, here, if you're selling 47, we have a bull channel line. You're selling the close basically at the bottom of the bull channel. You're trying to get a breakout below 40. By the time you get 49, the breakout has failed. Where did the move start? The move started with an opposite bar. It started with a bull bar. When moves start with an opposite bar and you get at least 1 R of the opposite bar, so it starts with a bull bar and you get at least 1 R of the bull bar on the way down, there's a 70% chance that you're going to get a move that's at least the size of this bar when it tests it before it goes above it. So I'll give a better example. Hold on a second. I'm going to come back to this slide, but I actually just want to, I studied breakout points last night a lot, so I have to go over that really quick. So this is a perfect example right here when we have a bull bar and then we have a 3-bar micro channel for the bears. When you start out with a bull bar, it's more likely that we test back to the bull bar. So when you get a bear 3-bar micro channel, there is I believe 44% chance that we test back to, if a bear 3-bar micro channel that starts with a bull bar, so basically a 4-bar micro channel, there's a 44% chance that it tests back to this low before the symmetrical second leg occurs. And when it starts with a bar that is in the direction, there is a lower probability because less traders are trapped. And that might sound confusing, but just think of it this way. In general, are you more willing to buy above a bull bar or buy above a bear bar? In general, you're going to be more willing to buy above a bull bar. And so in general, traders are going to be more willing to sell above a bear bar than they're going to be to sell above a bull bar. And so here, in general, more traders are going to be willing to buy. Again, I know it's context dependent, obviously, but just as a generality, more traders are going to be willing to buy below a bull bar. And so when traders buy below a bull bar and get trapped with a strong 3-bar micro channel, if they're willing to scale in, a lot of times it'll come back to this area. But if it does, there's going to be sellers there. And so what I found is that once we test back, 70% of the time, we're going to get a move that's at least the size of 44 before we get above 44. So once we test this low, again, you start with an opposite bar, you get a 3-bar micro channel. 70% of the time when we test back to this low, we're going to get a pullback that's at least the size of 44 before we go above it. So because there's a high probability, again, if you bought below this, you got trapped. So those traders, the algorithms who are willing to scale into this, if they get let out, they're going to sell. We have 3 legs up. There's traders looking to sell up here. And I just wanted to go over a little bit more about breakout points. Again, here's a perfect example. And this is where the two kind of intertwine. I'm going to go over more about channels, but this is kind of where those two things overlap. Traders who, you see bar 13, we have a 4-bar micro channel, 10, 11, 12, 13. You should be able to sell above 13, and this shouldn't happen. In general, you should not get a strong 3-bar micro channel after a 4-bar micro channel for the bears. So a trader who sold above 13 is probably a reasonable thing to do. You probably shouldn't get trapped like the way that you did. But if you did get trapped, you're looking to, a lot of those traders, the algorithms, will be looking to scale in and get out when it tests it. And since it started with an opposite bar, there are more traders willing to sell this high. It's the same way. Look at 5, 6, 7, 2 huge bars. Where are traders going to be willing to, or this went a long distance. It obviously doesn't close that great, but 6 and 7 is enough for a second leg. Where are traders going to be looking to buy? They're going to be looking to buy the bar 5 high, because a trader who sold this high, again, it's not a great trade, but because there's 3 pushes down, but you shouldn't get trapped to this extent if you sell above 5. So the traders who scale in will look to buy back their shorts. And so it's more reasonable to buy above the 5 high here when traders have gotten trapped. And 26 is not only selling a bull channel line, because this is a breakout on a higher time frame. The bull channel is you would also be selling right at the 13 high, where the traders who got trapped 14, 15, 16, again, 70% of the time in this situation where they get trapped by a 3-bar micro channel, you're going to get a bounce for at least the size of 13 before before this gets below 13. So when 26 tests this high, as a generality, 70% of the time, you're going to get a move that's the size of 13 before we get below 13. So it's really not that great to be selling. And you're also, again, you're selling on support. If you're going to sell, where do you want to sell? You want to sell where the traders got trapped, the 23 low, the opposite bar. In channels, you want to sell high and you want to buy low. And so again, if it's a bull channel, it's probably like this, it's probably better just to look to buy down here and buy those lows. But in this situation, a trader sells the 23 low during 28 and they can make a scalp. That's the size of 23 during 28. And yes, I'm not going to show you losing examples. I'm cherry picking these examples because they're the examples that best demonstrate the point I'm trying to illustrate. It's 7 times out of 10, it works. You can see 44, right? Traders got trapped selling above 44. We tested it on 67. They were able to make a scalp. So again, it's not a perfect thing, and it doesn't work every single time, but it's even higher probability in channels. So the reason I'm showing it in channels, it works less in trading ranges, in tight trading ranges. This sort of thing only works 60% of the time, but it actually might be a little. I have the stat somewhere. I'm not going to bother looking at it right now, but I know that in channels it works 80% of the time. So the best time to look to buy the retest of an opposite bar where traders got trapped, you want to do it with the trend, with the always in direction, is in a channel. And I have one more breakout point example that I want to show. I got a little sidetracked from the generalities of channels. I will get back to that in a minute. But here we go. This is a breakout on a higher time frame. And this is kind of thinking about the higher time frame is kind of where a lot of this is going. As I've said, this is a breakout on a higher time frame. So that higher time frame is this. And you can see traders got trapped below the opposite bar. In general, again, it's a late leg, but if you're buying below a bull bar in a 3-bar micro channel, there should probably be some buyers here. Excuse me. Sorry. So if you're willing to buy below this bar and scale in, even though you get the breakout and follow through against you, we'll probably at least test this low. But if you bought below this bar, this is not what you wanted to see. So those traders scaling in, they use this bar to exit at break even. And the bears know that, so that's why they're selling there. And that's the high. This is a 15-minute chart, right? But this is demonstrating the point of when traders get trapped on an opposite bar, when we retest that opposite bar, there should be traders willing to buy here. Even here, I don't know if this went one tick below, but you can see if you sold above this, you probably should not have gotten trapped. And so again, this is like where I'm saying it's not perfect. A lot of times it'll pull back deep within the bar, and you can do your own research on how you want to trade it. But if you sold this high and scaled in, when we come back, you know we should come back to test it. And when we do test it, you know that's going to be support. And you can see that's where we started to bounce. It's also the bottom of this, this leg in this channel. Over here, if you sold above this bar, you had, a 4-bar micro channel. It's a tight bull channel up, so you don't really want to sell above this bar. But this bar should not happen after this bar. And so when it does, when we reach back to it, there are trap traders here getting out, and that's where we reverse. So, and here, you shouldn't have gotten trapped below this bar. A trader who bought below should not have been trapped. This is an example where this doesn't work. You can see we rallied right above it, bull regime in general. So again, it's not a perfect thing. Here, bull bar, shouldn't have gotten trapped. You did. You could sell. So thinking about the breakouts and how opposite bars work, especially in channels, again, it's the most effective when you're buying a deep pullback. When you're a bull buying a deep pullback in a bull channel, this is where buying breakout points, in my research, personal research, do your research on it if you disagree or if you want to find something out. But this is where my personal research shows it's the most effective to be buying those breakout points. And this is another example of channels. And this is more higher time frame, right? So the market cycle here is we have what is this on a higher time frame? It's 9-bar micro channel. This whole thing is a bull spike. It's a bull spike on the higher time frame, which I will pull up in a second. But It's a bull spike on the higher time frame. So you're selling the pullback. So what's the market cycle? Spike, pullback, channel. So this is likely a late leg, 1, 2, 3, or 1, 2, 3. It's confusing, and it's probably a late leg. And so traders would expect that they should. Sorry, I'm losing myself a little bit. It's a late leg. Let me restart. Spike, and you're selling the pullback, and you should be expecting a channel to the upside. Another example of this is this slide that I have. Nope, different slide. Hold on a second. I'll pause and I'll find it. Is this slide. This is a higher time frame breakout. This is, again, just think about everything I've gone over so far. I apologize. This video is a little bit choppy. I kind of made the presentation. I don't have the best handle on all of it. The part of that is because I'm still learning this stuff. I still have a lot to learn with all of this. And this is just the research I did this morning. So I put all this together this morning, and I'm still, a lot of times I make videos as a way to help myself learn. And I've been a little bit bored of daily reviews lately. That's why they've been a little shorter. And I'm really interested in the research that I'm doing right now. And I'm just very passionate about, obviously, trading. And I'm really enjoying this bit of the research. And so this is why I haven't made a daily video in a couple of days, and why I decided to make a little bit of a longer video to try and help myself understand, and hopefully help you guys understand a little bit more about when not to take these trades. But anyways, this is a bull spike on a higher time frame. This is a 2-3 bar micro channel. I'm not going to pull up the 15-minute chart, but this is like July 7th or 8th or something along those lines. This is a bull spike on a 15-minute chart. So if you look at the 15-minute chart for this day, this pullback is probably spike, pullback, channel. It occurs all the time on these lower time frames because trading range comes after, or the higher time frames. You can see here, spike, pullback, and then weak channel, a couple of legs. Here's the market cycle occurring on the lower time frame. This is the market cycle occurring on the higher time frame. And again, hard not to sell 21. I did take 21 on this day. I thought it was a good trade. But again, on 51, you'd be selling the channel line. You do not want to sell the bear channel line. If anything, you want to look to sell higher. Maybe somewhere in this area, you could sell the gap closure. The traders who bought below 27, should have they gotten trapped? No. So when we get a 3-bar micro channel against it, and then 31 rallies, there's going to be sellers at that 27 low betting they can make a scalp, because if you bought below 27, of course this is disappointing. So the traders, they sell out of their longs. The bears sell the low. And again, high probability that when traders get trapped on an opposite bar, especially in a reasonable situation, a situation where they shouldn't have gotten trapped, high probability that those traders are able to make a scalp. So it's really all about learning when traders should not have gotten trapped, and then going from there. Here, what are the odds that 64 turns into this? Not very high. If you sold below 64 one tick and put a limit order 10, 15 points down here and a stop above it, you probably should have gotten stopped out. So there was a trader who was willing to do the opposite. And if they're willing to scale in, once it gets back to that price, you can see those traders exit. This demonstrates both of my points. You can see tight channel up. So you do not want to sell this because we have a clear higher low and then a higher high. So if you're selling here, you're probably selling a higher low. I think that's actually the best way I put it so far. So when you have a higher low and a higher high, be cautious selling because you might be selling a higher low. So that's actually a better definition. I'm probably going to start using that from now on. So when you get a higher low and then a higher high, be careful selling because you might sell the higher low and get trapped. And look, if you sold a tick above 35, it's a high one, but it's a bear bar. Yes, this is very strong and should get a second leg. But in general, selling above this high one, you should not have gotten trapped the way you did, where you didn't even have a chance to break even after 36. And so when we get back to that price, bulls are willing to buy here, and it's a channel. We're in the second leg of the channel. We should get one more leg up. So channels, you have to expect deep pullbacks. That's the market cycle. So here, you're expecting a deep pullback. Traders buy this high. I'm just going to go back to this slide for a minute, just so you guys can see it. Remember, I said this is a spike on a higher time frame and a two-legged pullback, and then you're expecting a bull channel. This is that higher time frame. You can see it just ends up being a 9-bar micro channel on the higher time frame, and then you would have been selling here. This is that signal, that bar 45 signal from a second ago. It's a third leg down, and even if it's a second leg down, you're still trading against a higher time frame where we should be starting the channel phase soon, which we did. So you have to keep all that stuff in mind. So the biggest takeaway from this entire thing, really, I get that this is confusing, by the way. I've not done the best job making this video. Let me just pull this up. But like I said, I'm still trying to learn all this stuff. And I still have a lot of work left in trading, but that's fine. I like doing it. The biggest two takeaways from this is if you are in a bull channel, do not sell because you might be selling a lower high. So don't sell in the lower third of the bull channel. And if you are in a bear channel, don't buy in the upper third of the bear channel, because you could be buying the first trend line break. You could be buying, again, just essentially high in a trading range. So don't do that. The other big takeaway from this video should be when you have an opposite bar in the market, like this, I'm saying collapses below it in this situation, and traders get trapped in spots where they shouldn't, there will be traders looking to bail out of that trade when we reach back to it. So you have to expect there to be sellers here. The more egregiously the traders get trapped, the more often that there are sellers in that area. And as a generality, I found when you get an opposite bar and then a 3-bar micro channel, 70% of the time there's going to be traders looking to sell this low. And just one more small thing, it's a good example of why no support and resistance is random. This bar right here, you can see the traders, if you sold above this high, you should have at least gotten a chance to break even, but you did not. It was a late leg. Again, not a great trade. We don't have to retest it, but in general, this shouldn't happen. You shouldn't immediately get a 3-bar micro channel. And so I was curious, if it doesn't test on the same day, what happens the next time we test this price? I just wanted to see what happened the next time we tested this price. And this is an example, the most extreme example that I found, but the example showed, like this sort of thing showed all over the place in the market. No support and resistance is random. And so you can see on this day, we had a big bull trend and it stopped right at that price. It was the next time that we tested that price. And since we gapped down below it, it should have been support, but we ended up gapping down below it. So when we reached it the next time, it's resistance. So when something should be support and you blow through it, it becomes resistance. But all right, I'm going to wrap up this video there. Like I said, look at this low. We went sideways. Like I said, sorry if this was a bit of a choppy video, but I'm still trying to work through